Hello everyone, welcome to our channel Brilliant Bankers, where you can expect in-depth classes on exams conducted by IIBF. Myself, Nishant, and today we are diving deep into the world of bank financial management, a crucial subject for CAIIB exams. Understanding the intricacies of financial management in the banking sector is not only essential for acing your exams, but also for excelling in your banking career. Throughout the series, we will unravel the core principles, tools, and strategies from the backbone of effective financial management in banks. We will be covering a range of topics, including risk management, capital adequacy, asset liability management, and much more, providing you with comprehensive understanding of the critical subject. Expect in-depth explanations, real-world examples, and practical applications that will not only help you pass the CAIB exam with flying colors, but also equip you with knowledge you need for success in banking industry. So if you are ready to embark on this journey of mastering bank financial management, hit the subscribe button and join a community of aspiring banking professionals. Stay tuned for more insightful content and let's excel together. Let's get started. Bank financial management. In bank financial management, we'll be starting off with chapter 1, exchange rate and forex management. So what is exchange rate and forex management? To give you a small intro, world trade, export and import of commodities, cross-border movement of manpower and capital, travel and tourism, and export of services and software all necessitate the need of exchange of currency of one country into another. The export of goods manufactured in India or exported of software from USA are paid in dollars, where the export needs to convert the USD proceeds of the bill into the Indian rupees. Similarly, import of goods from Germany into India are paid in euros. In this case, Indian rupees are converted into euros. Thus, conversion of currencies from one home currency to the other home currency will be generally required for all cross-border transactions. This is what is known as foreign exchange. It has been defined under Section 2 of the FEMA Act as all deposits, credit, and balance payable in foreign currency and any drafts, traveler's check, letter of credits, bills of exchange, expressed or drawn in Indian currency and payable in any foreign currency, or any drafts, traveler's check, letter of credit, and bill of exchange, expressed or drawn in foreign currency and payable in Indian currency is what is FEMA. For a brief understanding, in other words, a forex transaction is a contract to exchange one currency to another currency at an agreed rate and an agreed basis. Exchange rate denotes the price or the rate or the value at which one currency is exchanged with an other. It is a dynamic rate which varies day to day, minute to minute, and even second to second. In practice, a few times every second, depending on the variety of factors. Normally, it changes 4 times in a second. This is what we call a few times in every second. Forex market. It's a large spectrum which includes individuals, business entities, commercial and investment bankers, even central bankers, cross-border market, arbitrators, and speculators across the globe who buy and sell currencies for their needs. It is a communication based market which works with no boundaries and operates round the clock within a country or between countries. The markets of the foreign exchange are in different time zones. How? For example, the forex trading in India takes place between 9 a.m. to 5 p.m. timing is almost the same in each and every country. So by the time our market comes to an end, the US market is starting to open up. And by the time the US market is coming to an end, the Singapore or the Japanese market is starting up. So this is how it goes round the clock. It's a 24-hour market. Who are the major participants of the Forex markets? The major participants of the Forex market are central banks, commercial banks, investment bankers, Forex bankers, corporations, and individuals. The factors determining the exchange rate mechanism. There are two types of factors that affect the exchange rates. They are the fundamental reasons and the technical reasons. The spot rates, being the base rates in the Forex market, are dynamic and are affected by varied reasons. Coming to the fundamental factors, let the first one is balance of payment. Balance of payment generally, if it is in a surplus, it will lead to a strong currency, while whenever it is in a deficit, it will lead to a weaker currency. What is surplus and deficit? Whenever the exports are higher than that of imports, in that condition, the foreign transaction or the forex transaction is in a surplus to our country. So in this condition, we say the balance of payment is in a surplus, or vice versa. Whenever we start importing more things, we pay out the foreign currency, where the balance of payment, the outflow is more and it is in a deficit. Economic growth rate. In the condition of economic growth rate, whenever there is a high economic growth rate, it deals for import of things, and there's a fall of value of the national currency. And whenever there is a low economic growth rate, the exports are more and the purchase power of an individual reduces. As the economic growth is high, the purchase power increases and people start buying things. So when you start buying things, the import increases. When import increases, the outflow of the currency also increases. Fiscal policies. What's a fiscal policy? It's an expansionary policy by the government. Whenever the tax rates are low, of course, it's not going to be. Whenever the tax rates are low, people have a tending to purchase things because they do have surplus of money. They start purchasing things. When they start purchasing things, again, the outflow is high. What's the next point? The monetary policy. It's the way a central bank attempts to influence the central policies and the money supply can impact the value of currency of the country. Whenever the central bank, for example, the condition of RBI in India, whenever there is a change in SLR or CRR, if the SLR is reduced, the flow of cash in the market increases. When the flow of cash in the market increases, individuals or the corporates tend to buy a lot of things. When people are in a habit of purchasing things, automatically the import increases. If I do have cash today, I won't go for an Android phone. I'll be going for an iPhone. So what happens? Import. The best thing is that iPhone started manufacturing in India, or it was being imported from China. So we go for imports, where again the balance of payment, the outflow is more. Interest rates. Whenever there is a high domestic interest rates, overseas investments will be attracted to our country. Thus, the currency appreciates for a short time. Whenever the overseas investment is attracted to our country, the currency appreciates. So that is one fundamental reason. And it stays in for a long time, when it stays in for a long time with a high interest rate, the economies will slow down, which leads to a weakening of the currency. So the interest rate is a very big thing. Whenever the interest rate increases, people from other countries start to invest in our country. If it is for a short period, it's well and good. So there is a hike in a economic growth. And if it is for a longer period, the economy will start to slow down, thus weakening the currency of a country. Political issues. Stability is likely to lead the economic stability. Political stability is always a main factor which leads to the economic stability. And have a steady currency, while political instability can have the opposite effect. What are the technical reasons? Government controls can lead to an incredible value of the currency, resettling or in violating the exchange values. Freedom or restriction of capital movement can affect exchange rates to large extent. Speculation. Speculation phases can have a major effect on the exchange rates. Coming to the next one. Economic exchange rate mechanism. So what is an exchange rate mechanism? Exchange rate mechanism is based on delivery of forex deals. That is the settlement of the forex deals. So what is settlement in forex deals? For example, if I am purchasing something today and the payment is made the same day, it's called ready or cash. If it is done the next day, it is called TOM, TOM. If it is done the third day, that is the trade plus 2 days, in that condition, it is called spot. And the day after that is called the forward dates. That is, settlement of funds take place on the same day, it is ready or cash. Settlement of funds takes place on the next working day, it's called TOM. Settlement of fund takes place on the second working day following the trade is called spot. And delivery of funds takes place any day after the spot date is called the forward rate. Forward rates are generally derived from spot rates from the date of the trade. It's normally in premium or discount. So what is a forward rate? Forward rate, as explained earlier, whenever it takes place after 2 days of the trade, it can be a month, it can be 3 months, it can be 6 months, or anything. So in that condition, if the value of the currency goes up, it's in a premium. The currency is in a premium. If the value of the currency comes down, it's called the currency is in a discount. So what are currency codes? The price of currency can be expressed either as a unit of home currency, which is equal to so many units of the foreign currency, or 1 unit of the foreign currency, which is equal to so many units of home currency. As we mentioned, $1 is equal to rupees 74.85. This is what we tell as a direct quote. So what is a direct quote? The quotes are of two types: direct quote and indirect quote. Direct quote. Here, the rupee value of foreign currency is known directly. The rupee value of the foreign currency is known directly. Currencies, it is also called home currency or price quotation. Here the motto is always buy low and sell high. The motto is always buy low and sell high. For example, as we mentioned earlier, how do we say that? It's $1 is 74 rupees 85 paise. This is what we normally tell. What is an indirect quote? In this case, the local currency is fixed and foreign currencies differs. So the local currency is fixed to 100 rupees, or as per as in any country. In our case, it is fixed to 100 rupees, and US dollar differs. And this is normally used in the case of Great Britain pound, Australian dollar, euro, and the New Zealand dollar only. In all the other cases, we don't use the indirect quote. Here, the motto is buy high and sell low. For how do we pronounce it? Rupees 100 is equal to US dollar 1.3242 oblique 1.3240. This is how we tell the indirect quote of a currency. What is fixed and floating rate? What is the fixed rate versus the floating rate? Foreign exchange rate is the official rate by the monetary authorities for one or more currencies. Under floating rate, the value of the currency is decided by the supply and demand factor of a particular frequency. How? Whenever there is a demand and the supply is less, the rate increases. And when the supply is more, the price decreases. This is what is called the floating exchange rate. In some cases, the fixed rates are allowed to fluctuate between a definite upper and lower bands as fixed by the monetary authorities of the country. Under floating exchange rate methodology, the value of the currency is decided by the inflation differential between the home currency and the foreign currency and the supply and demand factors of that particular currency, as mentioned earlier. What is bid and offer rate? Whenever you see the price of a currency, of a forex currency, you will see it like this. Initially we'll go what is bid and offer rate. The buying rate by a bank. The rate in which the bank is ready to buy something is called a bid rate. And what is an offer rate? The rate in which the bank is ready to sell the currency is called a offer rate. Bid rate and offer rate. If a US dollar to INR conversion is mentioned as 79 rupees 20 pies oblique 25. In this case, the 79.20 is the rate at which the bank is ready to buy the currency from an individual or from anyone. That is 79.20, the bank is ready to buy the currency. So what is this 25? This 25 is at the rate at which the bank is ready to sell. That is 79 rupees 25 paise. The bank is ready to sell the currency at 79 rupees 25 paise. That is the same case if the Great Britain pound for US dollar is 1.6600 and 10, then the bank is ready to buy at this rate 1.6600, whereas the bank is ready to sell at 1.6610. Cross rates. Here we will go for a calculation of how the transaction is done and when is the cross rate being used. When rate of a particular currency pair is not available, then it is obtained indirectly using cross rate mechanism. I think you're getting it. Whenever you want to convert, we do have a direct quote for US dollars. Where we don't have a direct quote, that's in the case of Great Britain pound, in the case of euros, in Australian dollars or New Zealand dollars. So whenever you want to exchange money or the currency from INR to euro, Australian dollar, New Zealand dollar, or the Great Britain pound, in that case, we are using the cross rate mechanism. So in this condition, Mr. Z wants to remit 25 euros on an import that he has done. We will be going for the calculation here. In the calculation, it is mentioned that USD $1 is 76.10 oblique 25, where 76.10 is the bid rate and 25 is the selling rate. So the bank is ready to buy at 76.10 and sell at 25. 1 USD is equal to euro 1.06. I think that each and every person here has gone through the basic maths in school. So we will be doing the same thing. Here we will be going for the LHS versus RSS. RHS, that is 1 by 76.25 is equal to 1 by 1.06. We go for a cross multiplication where we come to know that 1.06 euros is 76.25 rupees. So what is 1 euro? That is 76.25 divided by 1.06. On calculating it, we can arrive at the 76.25 divided by 1.06. 71.933. So this is the value of 1 euro for in Indian rupees. This is how we calculate the cross rate mechanism. Value date, the date on which the payment of funds or an entry to an account becomes actually effective and or subject to interest if any. What is subject to interest if any? If there is a delay, if the transaction is done on a ready or a cash method, you don't have a delay. The importer is happy and the exporter is also happy because the payment is done on the same date. When it comes to the term or a spot, they do have a delay of a day or two. Again, coming to the forward rates, whenever the payment is done with a margin, forward margin, there is a delay. In that condition, the payment of interest is also done and the day of payment is counted as the value date. In case of telegraphic transfer, the value date is usually the same in both the senders. That is, the payment of the respective currency in each sender takes place in the same day. So no gain or loss of interest accrues to either of the party. What is arbitrage in exchange? Arbitrage means simultaneous buying and selling of the same commodity in two or more markets. For example, in the condition of NSE and BSE, if you have ever checked the rate of any shares, there will be a small difference in the price in NSE and BSE. So arbitrage means buying a share in NSE and selling it in BSE at the same time, so that he can, the person, the trader, can take the small factor of profit in it. In the case of Forex transactions, it consists of purchase of currency from one sender and immediately reselling it in another sender. What is a Forex dealing room? The Forex dealing room operations comprise of service branches. There are, in a Forex branch, you can take it as three parts: the front, the back, and the mid office. The front office, the mid office, and the back office. So in this condition, you do have separate three offices to manage all things. And what do they manage? The function of a service branch to meet the requirement of customers of other branches to buy or sell foreign currency, manage foreign currency assets and liabilities, fund management, manage the nostro account of the bank, and also undertake proprietary trading in currencies. It acts as a separate profit center for banking institutions. There are three types of offices: the front, the mid, and the back office. What are the duties and responsibilities of a front office? A front office dealer maintains two positions. One is the fund position, and the other is the currency position. So, what does he do in a fund position? In the fund position, the dealer reflects the inflow and the outflow of the funds. Any mismatch in the receivables and payables will throw an open interest rate risk in the form of possible overdraft in the nostro account of the bank. Whenever there is a mistake in the inflow and the outflow, their nostro account will be affected and it will show an overdraft in the nostro account. So, what is a currency position? It deals with the overbought and oversold positions arrived after taking various merchant or interbank transactions. What is overbought? Mr. A comes to the bank saying that he wants 1,000 US dollars. At the same time, Mr. B comes in. He is saying that I have 1,500 US dollars. Is the bank ready willing to buy? The bank goes for it and pays A with 1,000 US dollars. And at the end of the day, the bank is having this 500 US dollars in an excess. So this is the condition of overbought. So what is the problem in that? If the market opens the next day and there is a dip in the value of the US dollars, so there is an exchange risk for the bank. There's an exchange risk for the bank wherever when the value of the currency reduces. The fund position comprises of items that are ready in nature, affecting fund positions immediately or also in the nature of forwards, which affects the fund position of the letter date. What is a back office? It takes care of processing of deals, accounts, and reconciliation of the accounts. This function is of equal importance. Any laxity in the area would land the institution into unforeseen trouble. How? Coming to that. Either it may make the efforts of the dealers to generate profit. So the back office, it's their duty to make the dealers work efficiently. It could be so lax that the dealers indulge in misreporting of wrongdoings. Whenever the dealers do something wrong, if they are not ready to report, in that condition, automatically the bank will be going into unforeseen trouble. So, what is the main role of the back office? They are supportive and they have also the power to check over the dealers. So, they have both the roles. The first thing, they are supportive. It can make the efforts of the dealers to generate profit, and they have to check over the dealers to see that they are not misreporting anything. Mid office, it deals with the risk management and parameterization of risks for the dealing room. It acts as a check over the risk taken by the dealers, as also supplements them by giving the market information. Mid office is also supposed to look after the compliance of various guidelines and instructions and is an independent function of the bank. And that concludes our in depth exploration of Forex in banking management. We'll be going for the numerical questions in the next session. We will be able to try and practice some numerical questions. I trust you found this session insightful and valuable for your CAIIB preparations. If you have any questions or would like to dive deeper into any specific topic, feel free to drop a comment below. Your feedback is incredibly important. In our next session, we will unravel the mysteries of interest rate risk management. You won't want to miss it. So make sure to hit the notification bell to stay updated. Before we wrap up, a big thank you to each one of you who has subscribed, liked, and shared our content. Your support keeps us motivated. Remember, dedication and consistent learning are the keys to success. Keep up the great work, and I will see you in the next session. Until then, Jai Hind.